People have gotten used to the Fed coming in and helping them, right? They've gotten used to, and it's not their fault. They've gotten used to the Fed saying, okay, the stock market has fallen off. We'll come in and do something. Or they'll make sure the bond market is going up in price. Or even better, they'll make sure the value of your house continues to go up. None of that is happening this year or in the 2020s. And portfolios have to adjust or get left behind. We're going to cover what to do about it today and so much more. See you in a minute. Hey everyone, RC Peck here, and we have to talk about what went on this week. Now, I'm recording this video Thursday after the market has closed, so we still have one more day this week, but there's enough news that has happened. So I want to talk about what is going on in real estate, what is going on in the bond market, and what is going on in the stock market. Because the Fed, even though it helped people out for 40 years, 40, think of that as the 80s, 90s, 2000, and the 2010s. It is not doing that now. And people's portfolios have to adjust. So what we're going to do is look at some price charts and see what they are telling us. So let's keep things really simple today. This is a price chart of the NASDAQ 100 via ticker symbol QQQ. I have a simple moving average on here. It's a 200-day moving average. Okay, super simple. When the price is below the 200-day moving average, bad things happen. What I want people to take most away from this price chart is it's pretty much it being the price is hanging out and going lower below that 200-day, and the 200-day moving average is falling to the downside. And it's not just the NASDAQ. Here's the S&P 500 via ticker symbol SPY. It is, I don't even want to say it's caught under the 200-day. It's under the 200-day, and when price is under the 200-day, it is a period of instability, and that price has been under that 200-day for a while and is going to stay under that for a while. The Fed is not coming to the rescue. That's what Jerome Powell said this week. He said, look, rates are going to at least 5% federal funds rate. The market did not know that until he spoke. He also said there's going to be no pause in the rates until the federal fund rate gets to at least 5%. So it does not matter whether he raises rates 0.25%, 0.5%, or 0.75%. Rates are going to continue rising. Right now they're at 4% until they get to at least 5%. The market's not used to this. The last time this stuff like this happened was early 80s, late 70s. The problem is most people have their money in the stock market, in the bond market, and they never step out of it. So they just take the hits. Each peak you see on the S&P is basically Jerome Powell coming out and going, nope, not happening. And it almost doesn't matter. Here's small cap stocks, which look better than other parts of the market. But as you can see, even they are stuck under the 200-day. And then if we just pop over to the bond market, it's pretty bad. The bond market is not helping out the stock market. If we look at money lost or wealth lost this year, it's the biggest absolute wealth loss ever because stocks are down, depending on which market you're looking at or where you live in the world, 20 to 30 or 25 to 35%. And the bond market's down 15 to 20% on top of that. So literally people wanting to hide in those two massive asset classes are really getting hurt. Now, one interesting thing came out this week, and I'll just put Wells Fargo on here. So Wells Fargo came out and said their first-time origination mortgages are down 90% year over year. That's a big number. That means layoffs are coming to the mortgage market. Layoffs are coming to real estate. It's kind of weird with real estate because there are full-time professional real estate agents and there's a lot of part-timers. Those part-timers are not going to get any money from real estate. The full-timers are going to see their income greatly hit. This will probably be a white-collar layoff or a white-collar recession where people at Microsoft, here's Microsoft right here, falling hard and below the 200-day. Here's Amazon right here falling, oh my gosh, even harder. Here's Google falling even harder, right? So those are three massive companies Layoffs are coming to the white collar world, and it's going to affect them. But we won't see it immediately because white collar earners had such a huge wealth effect during 2020 and 2021 that it will take time to digest this information into the market. But the Fed is not coming to help, and some of the biggest companies on the planet are getting hurt. There's Nvidia right here, way, way, way below the 200-day moving average. And of course, we've got Meta, which is, you thought 75% down was as bad as it could get, and it's actually getting worse for Meta. This is the problem with the two-class share system. No one can fire Mark Zuckerberg. He can spend this company he can spend it into ruin. I don't think he will. I think there'll be a certain point where the pain will get so much that he'll have to listen. And there'll be a point. But the point is that these companies are getting hit very badly. Now, not all companies are, right? So you have Caterpillar that's doing pretty good. Now, it's still at the price it was at the beginning of 2021, 2 years ago. So it's interesting that a great price chart is something that has not fallen in 2 years. That's just telling you how bad things are in the world. We are in what I believe is a 2000 scenario. It's not the .com, it's gonna be called something else. And what I mean by that is kind of the new world order companies are falling much harder, which is what happened in the .com crash. Tech, NASDAQ, whatever you wanna call it, software, fell very, very hard and fell very hard relative to the S&P 500. And that's what we're seeing today. So really the analog of what's going on today is a bit 2000 and it's a bit 1974 because 1974 had high inflation, had inflation, and that's what we're having right now. Okay, so let's put it together. Bottom line, the Fed is not coming to help your home price. It has fallen here in the Seattle area. Home prices are down 25% this year. Now that's from a very high elevated point of view. Stock market, depending on which one you follow, is down 20 to 30%, and the bond market's down about 20 plus or minus. The point is the old buy and forget, rebalance once a year, 60-40 approach. Those approaches stopped working with the 40-year bull market in bonds. And the 2020s are going to be a very different decade for investing. And people will want to adjust their approach so that they leave the 2020s. I know that sounds like really far, 2030 from now, but it's not. It's right around the corner. You want to leave the 2020s with a bigger portfolio and not just because you put more money in. And the way you do that is really knowing when to step aside and not be caught up in I have to own bonds or I have to own stocks or I have to own fill in the blank, but literally to go where money is flowing. And right now, the only place money is flowing is the US dollar and energy stocks. Yes, I did point out Caterpillar. It is doing well, but it's flat for the last 2 years. That's not really growing. That's just being flat. And we actually want to grow our money. And now cash, when you get a money market, at least at Schwab and some of the other big custodians, you're getting that 3%. So the takeaway is the 2020s are not going to be like other decades that most people are aware of, and adjusting to your portfolio approach is really paramount. We manage money here at Fearless Wealth. If you're curious about what that might look like, you can click the link in the description and do a portfolio review with us. I don't know what you're going to love most about is just seeing how the unbeatable index compares to your portfolio, or really just noticing how many of your symbols actually are not helping you. It's good news, bad news, but what's best about it is just the amount of clarity and how to make the 2020s best for you. Let me know where you think I got it right, where you think I got it wrong, what I missed. I read all my comments. I respond to all my comments. So please continue doing that, and it helps. And if you like the video, please share it. That does help me out and help us out here at Fearless Wealth. Thanks, everyone, and I will speak to you, or you will hear from me in the next video. Okay, bye.